bringing you the latest in tax credit news, insight, and analysis. This is Tax Credit Tuesday with your host, Michael Novogradac.
Hello, I'm Michael Novogradac, and this is Tax Credit Tuesday. This is the March 4th, 2025 episode. My guest for this episode is Mark Shelburne. He's a housing policy consultant at Novogradac. Mark is based in Raleigh, North Carolina, but he works all over the nation, even Hawaii, and a little bit with Alaska. He works with stakeholders in affordable housing, including states and localities. This is Mark's 8th appearance as a guest on the podcast. Today's episode is another in our So You Want to Be a LIHTC Developer series. Now this week, we're going to focus on local governments and their critical role in local housing tax credit property development. And Mark is the perfect guest for this topic. He used to work as a state allocator of tax credits, and now he works directly with cities and counties. And he recently wrote a 4-blog series on the subject matter of today's podcast. I will link to that 4-blog series in today's show notes. Now, localities, namely cities and counties and other localities like townships and the like, are an important partner in a local housing tax credit property development. They may be thinking they're not technically a partner, Mike, and that is generally the case. However, there's a lot that they can do to improve a property's chance of actually receiving a tax credit award, as well as closing financing gaps, assisting with zoning, obviously, and many other aspects of a development. So while I'm not a technical legal partner, they're definitely partners in many ways. Now, today's podcast, as you can tell, is focused on and targeted towards cities and counties and other localities, but it's also a valuable tool if you're a developer who's working with these localities, and all developers are. It's a tool that developers can share with city, county, and other localities officials about some of the ways in which the counties, cities, and others can assist in bringing affordable, much needed affordable housing to their communities. As well as the podcast, our listeners should also be sharing Mark's blog posts with officials at various localities across the nation. We have a lot we want to cover today, so if you're ready, let's get started. Mark, welcome back to Tax Credit Tuesday. I believe it's your 8th appearance.
Thank you. I'm always happy to join.
Now, before we start, I mentioned briefly some of the services you provide to Novogradac clients, but please expand.
Certainly. My main client work is advising housing agencies. Most of them have been at the state level, but recently have been more and more among local governments on program design and implementation, revising policy documents, helping with various staff tasks and those sorts of responsibilities. And my other work next after that would be providing training, including I've got a 6-week course on the basics of housing credits coming up in May to June.
And that's one class a week, correct?
Correct, exactly. It's going to be every Wednesday afternoon for 6 weeks. And those who sign up for the certification aspect of it and pass will get a piece of paper saying that they passed.
Right. Thank you very much for that. Now, when we think about localities, it's somewhat a given that a city or a county, a township, other locality will be involved in a local tax credit development. There's obviously building permits involved. There can be zoning. There can be conditional use permits. There's a variety of ways in which localities are involved in the development of affordable housing. But I tend to think of a lot of those roles as more passive roles in the sense of that's government being government and exercising their functions. But there are other ways in which localities can be more actively involved in bringing affordable housing to their communities. Please share with our audience some of the ways in which localities can be more actively involved.
Right. Another way to think about it is doing the bare minimum versus stepping up to be an active participant. And at a high level, the reason to do the latter is because you can get more housing into your community. That's what really matters, that there's a tremendous need for affordable rental housing all over the country. And these credit dollars are going somewhere in each state. And so some of them could come to your city or your county, or they may not. And so being an active participant can help make that difference. But since I'm a program person, the other point that I like to make is that having your dollars, having your um, as we'll talk about later, revitalization plans, having those activities connected to the housing credit means that you, as a unit of government, get the benefit of what is by far the most effective compliance tool that our country's ever developed. And I know that may sound wonky, but the key to any subsidy working is for everyone to follow the rules and for the government to get what it's paying for. And that's done through compliance. And by using the tax code and connecting it to large financial institutions getting a return, those together combined make it so that it is a remarkably effective compliance tool. And that, in my opinion, is the reason why the program has been so remarkably successful, is all the interests are aligned. Everything works the way it's expected to. And so to the extent that you as local government are joining up with that, you get the benefit of that without even having to do anything. It's just right there.
Now, I appreciate the significance of the outsourcing of the ongoing compliance by virtue of the tax credits being there and the IRS, state agencies, and others being involved. So when we think about the locality being actively involved, I'm sure a lot of our listeners are saying the most obvious way is provide cash dollars. And you can provide cash dollars through grants or loans, theoretically, and those cash dollars help close financing gaps. But there's other ways in which localities can be involved. There's also, pros and cons of how you design those various funding sources. But even before talking about the funding sources and the pros and cons, maybe first talk about other reasons why funding sources could be desired by a LIHTC developer beyond simply closing a financing gap.
Right. And so I like to put things in categories when I'm explaining them. And so the first of those categories is what you were alluding to, which is the competition. The housing credit is a competitively sought resource basically every year in every state. And sometimes the competition can be as much as even 10 to 1. There's 10 applications for every one that gets funded. Now that's extreme. It's usually more like 2, 3, 4 to 1, but still that's competitive. Someone's going to lose. And so as one of my former coworkers would always ask when he's to developers, how do you want to lose when he's trying to come up with policies? And so, and one of the ways you can avoid losing, one of the ways you can get the resource to come to your jurisdiction in some states is by making loans from your sources that you have appropriated. The large one obviously is the home program, and there's some others, CDBG in some cases. And then of course, some cities have their own money that they put into deals. And so in various different ways, like maybe they float a bond, for example, the general obligation bond, or have a property tax revenue. And putting those dollars into properties that use the housing credit what that can do is it can let the state put in less housing credits than they would otherwise. And so that lets them spread the resource across the state and get more units built for the same number of credits that they have. Because the state only has a limited amount of 9% credits and once they spend it, it's gone. So the more they can get other sources into the property, the more they can spread that resource out. And so like in my home state, North Carolina, the way it works, one of the tiebreakers that can be very consequential is how much money you get into your property that is not from a bank, not from yourself where you're giving your own money, and not from the agency, because that's what's limited. And so the key source there is local governments to get money from them. And so the more of that you have, the more competitive you are. And so that's so one of the jurisdictions I work with, Raleigh, they are very effective in putting those dollars into properties and make it so that they can help determine which ones get funded and which ones don't. And so that's one way. But the other is what you mentioned earlier, the gap financing, which I could talk about more.
Well, first of all, I just wanted to put a bigger emphasis on your point about the locality, in essence, understanding how the state awards credits to various developments. And the locality can get involved as the state's developing its crop allocation plan.
Right.
And then the locality, once it's in place, can understand the plan and take steps to help ensure that affordable housing developments in their community will score well under that plan. And one of those, as you mentioned, is merely providing some level of funding, because in many states that can be a critical help in terms of winning the award. And we'll talk later in the podcast, there's other ways localities can help. But let's transition into the simplest way, which is that the locality is providing cash funding to the development to help close financing gaps and other reasons. And it sounds simple. It could be a grant or a loan, but because of the way the lowest attachment works on the rest, it's not that simple. So please explain to our audience the considerations that locality should have in mind when they're moving forward to providing funding.
Indeed. And just as a quick mention, the other benefit of putting your funds into these properties is, again, the closing the gaps. And that seems obvious, but the extent of it can be surprising in some cases. Like I'm also working with Clark County, Nevada, with their gap lending program. And what they're able to do is make loans, sometimes 8-figure loans to what are the tax exempt bond properties, because that's the size of the gap they have. And so they'll put that amount of money into a property, and that makes the property possible when it wouldn't have been otherwise. And so it's a lot of money per unit until you think about what you're getting for that money. You put in even $70,000 per unit, say $80,000 or more, but you're getting as a result a $400,000 unit. And so you're leveraging, you're making something possible that wouldn't have been possible otherwise. And so that, and that's more what happens with bond properties than with 9% deals. But yes, when you're making those loans, whether they're to be competitive or to fill a gap, the key is that at the property level, they need to be loans, not grants. And this is pretty well established, but just for folks that are new, the reason for that, and I'm telling this to an accountant, so you know this much better than me, is this notion of phantom income. When and it's going to be even more when we talk about non-recourse, because I don't, that's something that you definitely would need to explain more than me. But the notion of phantom income is that you, as a partner in the ownership entity, you would have to recognize taxable income, and yet you don't actually get the cash. It goes somewhere else. And so you have a tax bill. Unlike when you win the lottery, you think, oh, I got to pay a tax bill. We got a bunch of cash to pay it. In phantom income, you don't have the cash. And so that's a circumstance that nobody's going to accept. And so it's got to be a loan into the property. And so that's the first key thing. But the other is that loan itself has to be non-recourse. And that's where it gets into complicated tax notions of minimum gain and capital accounts that, when I've listened to you, Mike, at the ABA Forum Conference explain it in the years past, I've understood it briefly, but I wouldn't begin to try to explain it now. But some people want to say, what's the site? What's the reference, the code reference? Why it has to be on recourse? The answer is it just has to be. And it has to do with all those complicated tax issues.
That's right. It has to do with the treasury regulations, the partnership allocations. And
there you go.
Want to make sure that the investor for the tax credits can be allocated the tax credits for the full 10-year period. And if the loans are recourse to the developer, then at some point over the 10-year period, the credits might have to get allocated to the developer, which isn't what the deal is all about.
Exactly. It defeats the purpose. And then the other thing, when you're putting the money into these deals, what you have to think about is how you get it back out. And so is what are the terms of the repayment? What are the trade-offs, the benefits? And so there's 4 different ways to think about it. One of them is you don't get any payments back. You just let the money sit there, and you get it at a balloon on the back end. But the 3 kinds of payments, one is you just have a fixed payment. It's just a dollar amount, and It might amortize, it might not. If it doesn't amortize, then you have a balloon. The advantage of that is it's very simple. You send an invoice every, whatever it is every month, every year, however you set that up. Everyone knows what it's going to be. But the downside of that is you may not set the right amount. You may not set the dollar amount to reflect what the property really can pay, either too much or too little. And so the other way is to have it be cash flow, where you look each year, or I guess you could do it each month. That'd be a lot of work, to see what does the property have left over in cash flow. And if you do it right, then it pays exactly what it can afford. But the problem is someone's got to do that work. You got to look at all those records to see what is the right amount of cash flow. And then the third way is to kind of split that difference. What you do is up front, when you're estimating what the costs are going to be over the course of however many years, however long your loan is, you have the amount vary based on what the projected cash flow is going to be. And so it's still a fixed payment in that year, but the amount of it varies based on the projection. And with all these, you can always go back to the local government and say, we're having a problem. We can do maybe got to do a workout, and what its policies would be for that vary. But you're going to have to pick one of those four options when you put the money in, is again, how you get it back out.
So beyond making loans, and you did a good job explaining why they need to be loans versus grants, and then some of the terms of the loans that need to be in place, so that they'll be respected as loans and they don't interfere with the investor's ability to claim the tax credits. But there's also other ways in which a locality can help developers make LIHTC developments feasible. And let's start first with other financial, beyond loaning money. What are some of the other financial ways that localities can help make a development financially feasible?
The first one that comes to mind for me is donating land. That is tremendously valuable because land, the way the tax law works, doesn't generate the housing credit. So however much an owner has to spend on land, they have to effectively cover with debt. And so the less you spend on land, is ideally zero, that's how much less debt you have to bring into the property. That makes the property more feasible, or it allows the agency to use less credits, build more units elsewhere. And so that is tremendous value when the land is free. And it's also valuable from a practical perspective, in that if the local government's donating you the land, they're probably going to be a cooperative, patient transferor of that real estate, as opposed to if you're just buying land from someone on the market, then they may be impatient. They may be very demanding. They may expect you to pay all kinds of options and extension fees. And those kinds of things can be a real challenge if you're a developer working all that out. And so it can be much nicer to have a patient seller, a patient or a donator with the locality. And so another is depending on what the state law allows, because not every state law allows local governments to have flexibility to do the next idea, which is you waive things like tap and impact fees. Again, the rules for that vary, but those are just extra costs, and they may or may not generate the housing credit. Depends on a lot of facts and circumstances. But regardless, to the extent you don't have to pay them, that makes things easier and better for you as a property.
And here we're talking about capital costs kind of up front,
Right.
except that there's ways in which there could be operating expense adjustments. In California, it's common for there to be property tax abatements, but that really is coming at the state level, not so much the local level. But they might change in terms of annual operating expenses. Is it indirect subsidy up front because you can borrow more debt as a general matter, so you can use that to pay for higher costs.
Exactly. And it's true, the way that property tax law works is set in state statute. But local governments in many cases have some ability to implement it better or worse. And so, so you were then asking, what are some not financial ways to do it? And one that kind of splits the difference there is expedited zoning processes, and which we'll talk more about zoning later. And then also expedited approvals after you get your zoning and you get your award, how things move along in the project. Again, we'll talk more about that later, but having those be quicker and easier for affordable properties can be a benefit. But the big one is the Internal Revenue Code, Section 42, that governs the housing credit, requires the agencies to give a preference to properties that contribute to a concerted community revitalization plan. And so the agencies have different ways of implementing that, different extent of consequence that it has in getting an award, but they all have to do something. And so to the extent that a property contributes, again, to a concerted community revitalization plan, it should have some advantage in the competition to win. Again, how much of an advantage, whether it's enough to win, actually varies on a lot of circumstances, but it regardless will help. But again, the way that gets set up is that's one of those, to your point of understanding the QAP, that's where you really have to understand the QAP and what it says and how it works, because it's possible to have those set up in a way that doesn't get the incentive that the QAP provides if you don't understand how it works.
And you focused on, how the localities can help with QAP, help a developer access state tax credits, the federal credit, and if a state has a state law for the tax credit, help there as well by understanding the QAP and all the rest. And this goes beyond this podcast, but there's also oftentimes other available state funding that a locality could potentially be helping a creative developer access that funding for development in their area. So this really is a never-ending tale. And maybe we need to have you back on a podcast where we walk through all the various sources of financing that localities might be able to tap into. You mentioned home funds, maybe CDBG and the rest. And that's, not the topic of this podcast, but maybe give some thought to that. Maybe we'll have you back as maybe a 201. If this is the 101 for localities, that'll be the 201, which is what are some buckets of money that localities might not be aware of that they should be thinking about in terms of accessing.
Indeed, that makes sense.
Now, there's one thing that every housing tax credit developer knows, and every locality that's worked with a housing tax credit developer probably knows. There are some very specific timelines and deadlines. There are the timelines and deadlines that are all part of federal statute. You have to meet all of those, but then there's also at the state level additional timelines and deadlines in order to both access the credit, to compete for it, and once you win it, to be able to keep it. And you have to satisfy all of those. It's kind of a least common denominator test. Everything you do has to satisfy both those relative timelines and deadlines. Please share with the audience the ways in which localities can ease the burden or help developers in their communities comply with those various timelines, deadlines. And let me just note here, it's not, I don't ask the question from the standpoint of how can localities do the work that a developer should be doing? I'm actually looking at it and saying, how can localities work with the developer in a way that drives down costs? A, brings housing, step one, but step two, by minimizing some of these barriers, the cost of the development is less, and then the existing tax credit dollars and other soft financing can go across more developments.
Exactly. Yes. And something to understand about these deadlines, especially the federal, but really even the state deadlines, are pretty much all utterly unwaivable. They're just automatic. You meet them or you don't. And if you don't, then it doesn't matter the reason that you didn't. I know, given my age, I'll like to quote Yoda, there's no, you do or do not, there's no try. And that's it. And so it doesn't matter why you didn't meet the deadline. And so there's a bunch of them that we could talk about if we were being comprehensive, but I really wanted to just highlight the two big ones. The first one is the state deadline that kicks from a time sequence perspective, in that they don't want to, as an agency, you don't want to make an award. Again, you've got 2, 3, 4 to 1 competition. And so if a particular project doesn't get an award, there's going to be another one right in its place that falls right in behind it. And so there's really no point in giving an award to a property that isn't going to be able to get built. And one of the ways that you wouldn't get built is not having the necessary land use approvals, commonly summarized as zoning. But again, as you noted earlier, it could be conditional use permits, a number of things. And the way those break down, the local government folks know that there's legislative, quasi-judicial, and administrative. And the first two of those, legislative and quasi-judicial, they involve some degree of discretion, judgment call. And whereas administrative is just dimensional. It's just, do you meet the objective standards? And so pretty much every agency requires the first two of those, anything that requires any kind of decision-making to be done, even to apply. The idea being that you've got to get that worked out if we're going to even consider you for an award. And so what happens then, in some jurisdictions, they may not even realize it, but a developer will go there and they'll find a perfect site where they could bring great housing to the deadline for the application is X months away. And so they look at how long it takes to get the zoning, get the legislative quasi-judicial, and typically it takes X plus 1 months. And so if you're a developer, you look at that and you say, well, okay, that's not going to work. And so they walk away. They don't even try. And so the local government misses out on the housing because their zoning takes too long to complete. And so, but even worse is when you think it's X, but then you think it's going to be X minus 1, and then you're ready to go, and local government bumps you, kicks you out, and says, no, we're not going to vote on you this month. Then you spend all this money on land, spend all this money on design drawings, and now you don't have a deal because you're not going to be able to meet that deadline. And again, why would the state care? Why would they allow someone that doesn't meet the deadline when they've got a bunch of projects right behind it that did? That wouldn't be fair to those that did meet the deadline. So that's the state one. But the federal one is even scarier. And it's only for 9% projects. Bond deals don't have to worry about the place in service deadline. They have other kinds of scary deadlines. But for 9% projects, they have to place in service by the end of the second calendar year after they get their credits. And that is one of those hard and fast things. You meet it or you don't. And so where that kicks in is if you're a local government and you've got your plumbing inspector, your electrical reviewer, they're going out and looking at the property. And to the extent they take too long to get things moved along in the process, the property can have a problem. And that can either be something you see early on, like you don't get your grading permit in time. And so when you look ahead, you can see, well, okay, we needed that to be completed by June so as to place in service in December of the following year. And we're not going to get it done until August. And so, when you look at your construction schedule that you're not going to be able to meet it. And that can be a real problem. Or it could be a last minute disaster. You're at the finish line and something goes wrong. And in either case, you can have a developer whose hair is on fire, hopefully not literally, and that says, I'm doomed. I can't get this done. And there's a chance they're right about it because this deadline is so real and so scary and so automatic that, again, you have to get, and what it is the certificate of occupancy. You've got to get your COs by December 31st of that end of that second year. And so you need as local government to not get in the way of that.
Thank you for all of that. And I appreciate you pointing out that so many of these deadlines are absolute. And I sometimes refer to them as cliff, in that if you don't meet it, you fall off the cliff. That being said, there's always exceptions. And I would just say that, it's important that that developers and localities not count on exceptions, but if they think they're running into an issue, they should identify it rapidly and see if any exception applies. And the exceptions are quite rare. There's disaster areas, things like that can create some extensions, but that's super rare, not something you can count on. You have to assume there aren't any other exceptions, in that if you think you're going to run up to it, make sure you're dealing with those experienced in tax credit and housing more generally, so they can advise you on whether or not they're of the very limited exceptions that one could apply.
Yeah, that's a good point. When I teach the basics class, that's something I usually say at the beginning is pretty much everything I say has an exception. And sometimes there's an exception to the exception.
Yes, indeed. So Mark, this has been really helpful. before we wrap up, I want to give you a chance to share anything else you think our listeners and other members of our audience, those both on YouTube and those listening, should know.
Well, yeah. So as you mentioned, there's the 4-part blog post series that goes into more detail on what we just talked about. And referenced in that is to another blog post series on qualified allocation plans that I wrote several years ago. It's 10 parts where I basically just downloaded my experience of 50 or so QAPs that I've worked on into those blog posts. So that helps explain how they work. Also, as I mentioned, there's starting in May, the 6-week course on the basics of allocation underwriting, where again, you can get a certificate, potentially even a certificate with honors. That's a new thing I'm trying to innovate. And then the other is that to those local governments, or in some cases, state governments that are listening to this, to the extent you have these programs underway, we can help. Like, for example, one thing that's come up lately is, realizing that they're not doing enough review of their cash flow loans and thinking, it may be good if we have some actual accountants review the information we're getting to make sure that these properties are doing the right thing. So again, that's something that we can do to help as a firm, to help you do a better job implementing your programs.
That's also the whole cash flow work that you and others at Novogradac, those services that you provide for the local governments. They can end up obviously ensuring that they're collecting what they should be collecting. And then that gives them more resources to then recycle back into additional developments.
Exactly. It can pay for itself. Yep.
So thank you, Mark. I've also given you a few ideas in the course of the podcast that hopefully will tease you to come back.
Happy to.
But before we get to the off mic section, I do want to remind our audience to subscribe to the podcast on whatever platform you choose, and to please share the podcast with your colleagues who may be interested. And as I say most weeks, we do have a full archive of episodes available on our website at novoco.com. And on the YouTube channel, there's also a full playlist of all of the So You Want to Be a LIHTC Developer episodes. And I will share links to all of these in today's show notes. So now we've reached the off mic section. And Mark, as you know, we like to use this space to give a shout out to someone working in one of the many community development areas that we work. It's an opportunity to highlight a professional worthy of recognition. Mark, who would you like to shout out this week?
Yes. So I'm very happy to, I'd be happy to do it regardless, but it's a perfect fit for our theme today, which is my friend and former coworker, Emma Sutton, who I worked with when we were both at the North Carolina Housing Finance Agency, but she's now the Director of Housing and Neighborhoods for the city of Raleigh. And so she became a national expert on topics like supportive housing and homelessness in various capacities, including being a consultant. And she's taken that knowledge and expertise into working for my hometown here. And so, and has been just remarkably successful. They've had tremendous interaction, improving how they work with the housing credit, with 9% in bond deals, getting tremendous interest in their programs and resources, having great output, production. But they're also having real success in a pilot that they've got started to end homelessness. And they've got 45 households in this pilot that are enrolled, and they're helping them with all kinds of services. Every one of the 45 has some type of either the housing worked out or they're about to. They've got a plan for it. And that each of those folks that gets helped is going to save roughly on average about $70,000 in reduced hospital emergency services, law enforcement costs. So again, it's going to pay for itself. And so she's just remarkably hardworking, dedicated, and having excellent results on the ground. So I'm just honored to get to know her.
Well, thank you for that shout out. I'll echo your shout out to Emma Sutton. Thanks for all the great work you're doing for those in need of affordable housing and your efforts to end homelessness. So Mark, thank you for being on the podcast today. And
thank
to
you.
Our audience, I'm Michael Novogradac. Thanks for listening.
This weekly podcast has been brought to you by Novogradac and Company, LLP. Archived podcasts are available online at www.novoco.com/podcast or by subscribing to the Tax Credit Tuesday podcast in iTunes, Spotify, YouTube, Google Podcasts, Stitcher, and Radio Public. You can find related links referenced in this podcast on our website at www.novoco.com/podcast. Novogradac and Company LLP is a national certified public accounting and consulting firm with offices nationwide. Learn more about our professional services at www.novoco.com.